Hello, good day traders. I want to welcome you to PU Prime Africa. And in this video, I'll be sharing with you 7 mistakes made by beginner Forex traders. So if you're not watching this video, you're a beginner trader, you're an intermediate trader, these are tips you need to know to give you an edge in trading. So let's get started. So the first mistake made by beginner traders is trading without a plan. Now, most of the time, most beginners jump into the market without a ready trading plan. Now, there's this saying that if you fail to plan, you're actually planning to fail. And it works in Forex trading. Now, if you don't plan your trade, chances are that you will make a lot of mistakes. Now, what does a solid trading plan include? It includes your entry rule, your exit rule, your risk management, and the strategy you will follow. By entry rule, if you're using indicator or any price action tool, you're looking at making an entry, maybe when you find a chart pattern, a candlestick pattern, or a trend line breakout. Exit rule, there are two ways to exit a trade. One is if the price eats or take profit, or the other way around, if it eats your stop loss. Now, this has to be determined ahead of time, and also make sure you have effective risk management. Now, the second mistake beginner trader makes is risking too much on one trade. New traders often risk huge portions of their capital. This is a common practice with a lot of beginner traders. Many see Forex trading as a get rich quick scheme. They want to hammer on a single trade, and unknowingly, they are putting to risk as much as 10 to 50% of their equity on one single trade. When you're doing that, to be honest, you will find it difficult to be profitable on the long term, because when your stop loss gets hit, a large chunk of your account is at risk. Professionally, you are not expected to risk more than 1 to 2% of your equity per trade. This way, it will take a long while for your account to get wiped out compared to somebody who is risking 10 to 50% of their equity per trade. The third mistake made by beginner traders is overtrading. Overtrading simply means opening many random positions at the same time. Beginners feel the need to always be in the market. There's always this thing about beginner traders having itching fingers. You just want to place a trade. You just want to buy or sell randomly, and it leads to overtrading. Before you know what is happening, you are having 5 to 10 or more running trades at the same time. Now, the truth is that if the market goes against those trades, your accounts could get wiped out in the process. And this is one of the reasons why a lot of beginner traders do have their accounts wiped out, or the way we say it, gets blown. So good trading is patient. One of the key things trading will teach you is patience. If you must be successful as a forex trader, you must learn to be patient. Good trading is patient, not constant. It is more about quality over quantity. I do tell our students at our academy, at PU Prime Trading Academy, that it's better for you to have more quality trades than more of a quantity, or having so many trades, being opened. So go over quality, above quantity. The fourth mistake made by beginner traders is moving stop losses or trading without one. Now, let's start with trading without one. A lot of traders are afraid to use stop loss because they're afraid that the stop loss might get hit. Now, when you're putting a stop loss on the trade, what you're saying in essence is that you understand there's a risk involved in trading, and you have determined the maximum risk you're willing to take on that trade. So, peradventure the market goes against you, it's an amount of risk you're willing to admit or to accept. So let's assume you have $1,000 and you are risking just 2% of that account on the trade. That means you're risking just $20 out of 1,000. That is very reasonable and very fair. Now, if you now decide not to put a stop loss, it means that you are also saying that, well, I'm willing to take whatever comes with the market. So if your trade goes to minus 100 pips and 200, then your risk is getting higher. So we say that ignoring stop losses turn small losses into catastrophic one. It's more a case of being penny wise and pound foolish. Which is better, to risk $20 compared to your account getting as much as minus $200? So trading without a stop loss is a no-no if you want to be successful. Now, the other one is people now moving stop loss. You have set your initial stop loss at minus 20 pips. Then you see that the price is going to hit that stop loss. And out of fear, you now move that stop loss from minus 20 to minus 30. Then before you know what is happening, you again move from minus 30 to minus 50. Before you know what is again, you are moving up and up again. That way, exposing your account more to risk. When you're taking your stop loss after analysis, stick with the stop loss. If the market hits that stop loss and the trade close against you, it's perfect. Then you look for a fresh trade. Enter on a fresh trade with a clear entry. That's where you are still trading professionally compared to moving your stop loss or not using stop loss at all. So you should decide your risk before entering a trade, not after you have entered on the trade. Number 5 is chasing the market. Jumping into trades late because the market is moving leads to bad trades. Have you heard of people saying, oh, the market is buying now, enter buy, enter buy? You didn't analyze, you just jump into it. The next thing, you get a shocker, price reverses against you, and the trade turns into a loss. Stop chasing market. So another way people chase after the market is you see the green candle, then the next thing you enter a buy. Green candles don't mean buy. It only means the market is, having a bullish sentiment. You may enter a buy now, the next thing the market turns against you. Before you take a trade, always analyze the market properly and be sure the price will be going in that direction, not just because you want to chase what is happening in the market at the moment. So if you missed a move, learn to wait for the next one. Probably you even have a good setup, but price has moved. You didn't have the timely entry, you didn't enter at the right time. Then wait for the next setup. Patience is part of trading. Stop chasing the market. Number 6, trading multiple strategies at once. Now, this can lead to a lot of confusion when you trade more than one strategy at the same time. Constantly switching systems prevent consistency. You need to be consistent with your trading strategy. Not that you're trading price action today to tomorrow. I mean, just some minutes after you're switching to SMC, you're switching to another one. No, it brings a lot of confusion. Be consistent. Try to identify the strategy that works with your personality as an individual and stick with it. Master one strategy before adding another. Now, if you must add another one, make sure you have a perfect grasp of the one you are using earlier, or you're dumping that one altogether to learn something new. As much as possible, avoid trading multiple strategies at the same time. It can lead to a lot of confusion in trading. Now, the 7th mistake made by beginner traders is ignoring the higher time frames. Now, a lot of beginner traders are very, very guilty of this particular one. Most of the time, beginner traders focus on the very short time frame, 1 minute and 5-minute charts. That's almost the focus almost of the time. To be honest, those time frames are regarded as noise in the market. Most times beginner traders are after the action. Within 1 minute that's gone 5 pips, 5 minutes that's gone 7 pips, all these kind of things. It excites them. But see, the truth is this: when it comes to this trading business, the market often goes longer, goes better, more refined in the line of the long-term movement in the market. So higher time frames like daily and weekly time frames show the real trend and structure. And that is the truth. If your focus is just 1 minute, 5 minutes, and even some just stick with those time frames alone, they don't check the higher time frame for confirmation of trend. I tell you, that is one of the reasons that you are still having a lot of losses. If you want to be consistently profitable, then you should be checking the higher time frame. Check the daily or the weekly time frame for trend, and then look out for the smaller time frame, like maybe 1 hour, 15 minutes, or 30 minutes for entry. That way, you will see that you'll be more consistently profitable. All right, so these are the 7 tips I want to bring to you today. Mistakes made by beginner traders. I hope you've learned a thing or two from this video. If this video has been very educative, then go ahead and click the like button, share this video, and subscribe to this channel. And I'll come your way again in another video that'll be very educative about Forex trading. All right, take care, and it's bye for now.